Time now for your market news. Asian shares hovered below their 10-year peak today, while mainland Chinese shares were little changed after big falls the previous day and concerns about fresh government steps to curb financial risks and a rise in Chinese bond yields. Japan's Nikkei recouped earlier losses and ended slightly higher as expectations that the Bank of Japan would buy more exchange-traded funds offset drops in car makers. Mitsubishi Materials slumped after it said its subsidiaries had falsified product data. This is the latest in a series of quality assurance scandals involving Japanese manufacturers. The Nikkei ended up 0.1%. Hong Kong stocks rebounded as mainland shares showed signs of stabilizing. At the close of trade, the Hang Seng Index was up by 0.5%. The Shanghai Composite Index ended flat and Wall Street was closed yesterday for the Thanksgiving holiday. Now for more on the markets, we cross over to Nompumelelo Siziba. She's standing by at the Johannesburg Stock Exchange. Nompumelelo, Black Friday in the shop. Is it going to be a Black Friday for us in South Africa and the markets later on?
Well, that's a million-dollar question, isn't it? And of course, you're referring to the ratings agencies, Standard & Poor's and Moody's, markets expecting them to pronounce on our credit rating, that is on our debt status. Market consensus is that they're unlikely to move, that they'll keep their various ratings where they are as they look to see what will happen with the ANC elective conference and that key February budget next year. You'll remember that when we had the midterm budget, that really caused a lot of ructions, and we saw the rand depreciate quite substantially on the back of what the Minister of Finance had to say, saying that our budget deficit to GDP would rise to 4.3%, which was way beyond expectation and is not very good news in terms of our debt profile and our ability to finance our debt going forward. In the meantime, locally, we do see that the market is in positive territory at the moment. That might have something to do with the fact that the rand is on the back foot at the moment, and that might be partly to do, of course, with the anticipation of what will happen later on. It's quite unlikely that the ratings agencies will release this information during working hours. Chances are it will be after market close. So we'll only really get to see the results probably on Monday morning. Now, if it's negative and they do downgrade our local debt, to junk status, it's estimated that up to $12 billion could be sold out of our bond markets, which would mean a depreciation in the rand, negative news for inflation, not a pretty picture at all. So we're hoping, crossing fingers, that that is not going to be a Black Friday for us. Let's take a look at the indicators. Well, I'm joined by Warwick Lucas. He's Chief Investment Officer at Galileo Capital. Thanks for joining us, sir.
My pleasure.
I hope you're ready for lots of speculation. Now, what's your characterization of how global markets have performed this week, and specifically what the all-share index has been doing? We know Naspers, which is a very big heavyweight on the bourse, has been dragging down the bourse in the last couple of days, which is a little bit worrying because when things are going up with a stock like that, it's great news, but when things are going down, it's a bit negative, isn't it?
Yeah. Okay, so the markets themselves globally, a bit of a sideways week all in all. We've seen the dollar going a little bit weaker, so that's in line with a slightly risk-on kind of attitude. As far as the all-share index goes, yes, you're right about Naspers, and I mean, it's important to bear in mind that last week we did have 10-cent results come out that would have flowed through to Naspers. And by the same token, they had a great week, and I think a little bit of consolidation coming in there. But you're absolutely right in terms of what does it mean about the index. It suggests that it's quite hard to get a proper sense of, shall we call it, SAPTY Limited, when there's such big foreign or international companies in that all-share index.
Indeed. Now, many market observers are hoping that Moody's and S&P will rather wait and see what happens with the ANC elective conference and the February budget, as I mentioned in my introductory remarks. And of course, we had Fitch coming out yesterday unexpectedly saying that they're keeping our rating unchanged. They have us already, our local and our foreign debt, at junk, but they didn't lower our rating any further. Your thoughts?
Okay, so I think of the three agencies, Fitch probably had the easiest job. They cut furthest and hardest before any of the others, and they're in a position where they could afford really to put in a holding action. The other two agencies are at higher levels in terms of their ratings, and if I remember rightly, both of them are on negative watch. So there's a very tight eye there. They may choose to say, well, South Africa's at a T-junction type moment and give the benefit of the doubt for now. If they do, I think it really does need to be treated as last chance saloon.
As I mentioned, there's talk among market observers that if we do get the worst decision, a double downgrade from S&P and Moody's, we could see up to $12 billion coming out of our bond market. I don't know where they thumb-suck that from, but you know, that's the number that's been spoken about. You times that by 14 and you get a rough idea what that is in rand. But now, if foreign investors do sell out of our South African bonds, we do have quite high yields in excess of 9%. So what stops fund managers like yourself stepping in and buying up those bonds and enjoying those good interest rates?
Okay, so they can reasonably determine a number like that by the amount of passive investing, i.e. Big pension houses often just simply follow indices, so they can figure out, right, if we got kicked out of an index, how much money would be associated with that kicking out of an index, because it's basically a forced sale. So as far as what would local fund managers do, well, I think many of them, in anticipation of downgrade, have been relatively light on bonds anyway. So at the right price, they probably would be accumulators of bonds. But that still, of course, would mean a lower bond price and effectively higher borrowing prices for government. But I also think the area which is subject perhaps to greater risk of volatility would be the parastatals, Eskom, SANRALs, given their pretty poor financials.
And then yesterday, the Reserve Bank decided to keep the repo rate unchanged at 6.75%. In your view, was this a prudent decision?
I think under the circumstances it was. I think looking forward, there's quite a lot of visibility that the Reserve Bank doesn't have on events. I mean, the outcome of the December conference could very well be equivalent to a T-junction or heads or tails, take your pick, but it could have profound influence on the future direction of the rand and interest rates. So I think they're in a situation where they had to put on a holding pattern. I think as far as the future direction, they guided towards higher rates, a very shallow hiking cycle over the next 2 years, which I think is fair enough given the level of the rand and so on. But there's, of course, many events that can come between now and then.
Now, whenever the rand moves, people like to speculate as to what reason it's moved for, or whatever. And earlier in the week, of course, President Mugabe decided to resign, and we did see a lift in the rand, some people attributing that to his resignation. And now we do see the new president, Mr. Mnangagwa, coming in today, being installed as president. Do Zimbabweans' fortunes, economic fortunes, have a bearing on our fortunes and ultimately how the rand performs?
I think it certainly can contribute to setting the tone of the neighbourhood, and after all, we saw Mbete passing the comment that African leaders need to smell the coffee, and I think that's a fair enough comment. I think as far as the actual prospects for recovery go, well, it's quite an improvement simply to go from bad to less bad. So anything better than that is a bonus. And I think the reality is, given the proximity, given SA's own economic issues, proper recovery in Zimbabwe truly is a win-win for both South Africa and Zimbabwe.
All right. Well, thank you for your comments and your insights, as always, Mr. Warwick Lucas, Chief Investment Officer at Galileo Capital. Do have a fantastic weekend. After a short break, Nzinga has more business news for you.